What if I told you the US $38 trillion debt isn't their problem? It can directly change what you pay for a home, what you pay in rent, and what you pay for groceries. A number so big it doesn't feel real. 38 trillion. Most people hear national debt and tune out because it sounds like politics. But here's the truth. US debt isn't just a headline, it's a pressure system, and you live inside it. It shapes interest rates, prices, jobs, taxes, and the value of money, even if you never think about bonds once. So let's make this simple. This is the story of how the debt grows and how it quietly reaches into your wallet. First, one definition that clears up the confusion. The deficit is what happens in 1 year, when spending is higher than tax revenue. The debt is what happens after years of deficits, stacked on top of each other, like layers of concrete. Now picture a household. If a family earns $5,000 a month but spends $6,000, they're short $1,000. They cover the gap by borrowing. Next month they might borrow again, and now the balance grows. That growing balance is the debt, and the interest is the monthly fee for keeping it alive. The US does the same thing, just with a bigger tool. When taxes don't cover spending, the government borrows by selling treasury bonds. Those bonds are basically IOUs that pay interest. Investors buy them because they're considered safe, and because they want that interest. So here's the first key idea. The debt is not just a big number. It's a big number with an interest meter running 24/7. And once the number gets huge, small changes become massive. A 1% move on a tiny loan is annoying. A 1% move on trillions is a budget earthquake. This is why people call it a bubble, not because it pops like a meme stock. Because it grows for years, and the system becomes dependent on carrying it. Part 1. The interest rate channel. To understand how debt hits your life, start with the price of money. Interest rates are the price of borrowing, and the US government is the biggest borrower in the room. When the government sells more bonds, investors decide what interest they demand. If investors worry about inflation or risk or uncertainty, they ask for higher yields. Those yields matter because treasuries are a benchmark. They're like the base rate the rest of the system builds on. So when treasury yields rise, borrowing gets more expensive across the economy. Mortgage rates can rise, car loans can rise, business loans can rise, and yes, credit card rates can rise too. That's one way the debt reaches you, not by sending you a bill labeled national debt, by pushing up the price of borrowing in the background. Now watch what happens next. Higher borrowing costs reduce what people can afford. A family that could handle a $2,500 mortgage payment can suddenly only handle $2,000. That changes housing demand, and it changes rent pressure, and it changes everything connected to big monthly payments. And it hits businesses too. When borrowing is expensive, companies delay hiring and expansion. They cut back on risk. So debt pressure can turn into a softer job market, even if you never read a single policy article. Part 2. The inflation and purchasing power channel. Now let's talk about the fear people whisper about. They'll just print money. The reality is more complex, but the instinct is pointing at a real tension. High debt makes the system sensitive because policymakers have fewer painless options. If taxes go up, people feel it. If spending gets cut, people feel it. If borrowing keeps climbing, interest costs keep climbing. So there's always a temptation to let inflation do some of the work. Inflation is a weird kind of relief for a debtor, because debt is paid back in dollars. If each dollar buys less over time, the real burden of old debt can shrink. But that same inflation punishes everyone living on income. Your paycheck may rise slowly, but your groceries can rise fast, your rent can reset higher, your insurance can jump. So even if inflation helps the balance sheet, it can hurt daily life. And here's the trick that confuses people. When inflation goes down, it usually means prices rise slower. It doesn't mean prices fall, so the system can cool, while the new, higher price level stays. That's why people feel like the official number is lying, because your experience is not a statistic. It's what you pay every week. For the basics. Part 3. The Tax and Budget Channel. Debt also affects you through government choices. As interest costs rise, more of the budget goes to paying for the past. That leaves less room for everything else. So the government faces trade-offs: raise taxes, cut spending, borrow more, or mix all three, and hope growth makes it manageable. And those choices ripple outward. Higher taxes can reduce take-home pay or raise costs for businesses, which then raise prices. Spending cuts can hit services, contractors, and entire local economies tied to federal money. Even the fear of those changes can shift behavior. Businesses hesitate, investors demand higher returns, households save more and spend less. And when millions of people pull back at the same time, growth slows. Slower growth makes the debt harder to carry. So the system can slip into a loop, where weakness creates more borrowing, and more borrowing creates more pressure. Now, at this point, people usually say one sentence, but the U.S. can't go broke. It prints the dollar. That's partly true, and dangerously incomplete. Printing money doesn't erase consequences. It changes the form of consequences. Instead of an obvious default, you can get currency weakness. Instead of "we ran out," you can get money that buys less. Instead of a clean reset, you can get years of higher rates, higher prices, and tighter budgets. So the real question becomes this: how does the system choose to balance the pain? And who feels it first? Now let's add the reason this debt has lasted so long. The dollar is a global reserve currency. Treasuries are a global safe asset that creates constant demand from banks, funds, and governments around the world. And that demand helps keep U.S. borrowing costs lower than they otherwise would be. But it's not a superpower with no limits. Confidence can shift. Demand can weaken. And when the base is trillions, even small shifts matter. This is the danger of big debt. It doesn't need a dramatic collapse to hurt you. It just needs higher interest. For longer. It just needs inflation that sticks around. It just needs slower growth and tighter money. So what should you actually watch in real life? Watch interest rates, because they change payments. Watch inflation expectations, because they change pricing behavior. Watch growth, because growth is what makes debt feel light instead of heavy. And remember the core point. The debt is not a headline number. It's a system of incentives and pressure that moves through rates, prices, taxes, and jobs. So here's the final simplified takeaway. The U.S. $38 trillion debt bubble affects you because it influences the price of money, the cost of living, and the choices made when the system is under stress. You feel it through mortgage rates and rent pressure, through grocery prices and wage timing, through taxes and public spending, and through the job market's confidence. And the bigger the debt gets, the more the system manages consequences, instead of having clean options. If this made the debt headline finally feel real, then you're exactly the person this channel is for. When you subscribe to Finance Systems Explained, you'll start seeing the economy the way it actually works, as a system of incentives, pressure, and consequences. See you in the next video.